Today we're going to talk about demystifying the stock market. So why is this so important? It's likely your earnings, along with your 401k, your Roth, your IRA, whatever, is going to build your wealth. Again, quoting Terry Savage, two big mistakes young people make regarding investments for wealth. One, they think it's so complicated. Start to explain this stuff so their eyes glass over. And therefore they do less than they could and less than they should. Kind of deer in the headlights. They freeze. And they just go on to another topic. And then revisit it maybe when they're in their 30s. No, not good at all. The second mistake they make, they say, when I'm just entry-level wages now, but when I make some big money, then I'm going to carve out money to invest. Both of these are catastrophic mistakes. I can't teach you tons about the stock market in a short course like this. We cover so many topics. What I can do is teach you enough for your eyes not to glass over. You got some level of familiarity as you start to build on the knowledge. Remember, Transitions is a course that is really a foundation, and then you start to build on it through lifelong learning. So if you have a question or you say, geez, I wish I had more on that, jot it down, Google it, find out, and feed your head. Remember, I'm not a licensed stockbroker. I'm not a certified financial planner. So seek guidance from them as you proceed. But this is how you can start. How do you just leave school or early in your career and maximize the early steps to get tremendous advantage? That's what this is about. In a simple explanation, the stock market, or the equities market, same thing, is where you can buy and sell stocks, bonds, and mutual funds, usually through a licensed broker, or maybe you go ahead and do that online, but through a brokerage house. Again, in a simple way, stocks are small pieces of ownership of a company. Bonds, on the other hand, are loans from you to that company or that group who promise to repay you with interest. Mutual funds? Well, think of them as baskets that hold stocks, bonds, and other securities. These managers try to produce capital gains or income for their investors. Highly competitive. They rank these things all the time, and you've got people that have a nice diversified portfolio because they've got not one stock in these mutual funds, they've got a basket of them. So why should someone invest in the stock market? Well, stocks offer investors a greater capital appreciation and potential for growth over the long term versus other instruments like savings accounts, CDs, certificates of deposits at your local bank. So how do young people usually invest for the long term? Generally, there's three ways. One, a pension. We talked about those going away, so I wouldn't count on that. A 401k or a Roth or other vehicles, or an individual retirement account, an IRA. So let's go through them. Pensions, as we have covered, these plans are declining. So if you have one, great. But consider shoring it up a little bit, if you will, because often they've not been managed well. Politicians have underfunded these things, and it's been really, really a disaster. So you want to go ahead and maybe get some funds on the side, so if all of a sudden your pension doesn't pay off with what they originally promised you when you started to work there, you've got some extra money and you're fine. And use the power of starting early to help you with that as well. A 401k is a plan that your employer puts together where you can invest pre-tax money. So as the money comes in, before you pay taxes on it, you can go ahead and put it into a 401k. So it's substantial. Okay? Then you pay taxes when you withdraw the money. Well, what's a Roth? A Roth IRA is similar to a 401k, but you deposit post-tax dollars. So you pay the income tax on them, and then you put them in the account. And in retirement, this is the good part, you withdraw your funds tax-free. So why is that so incredibly important? Because you're starting early and you're going to have 40 or 45 years of your career. And as we get more into subsequent lessons about compound interest, your money doubling and doubling and doubling, you mean you're going to get some of that money coming to you tax-free? This is a really, really good idea. But often your employer will match the 401k, but not the Roth IRA. So some people say you go to the maximum of the match and then you start funding a Roth. But Google, look, do some research and figure out how you're going to go ahead and pull that off. Again, I'm not an advisor, so I can't tell you how to do this. There are rules for this Roth IRA regarding participation. If your income is too high, you may not be able to contribute at all. They'll just close the plan to you. You can get details on the internet or brokerage houses like Fidelity, Charles Schwab, Vanguard, or certainly there's tons of others. The Roth is great in the early years because you want that compound interest to come back to you tax-free. That's huge. If your employer does not offer a 401k, not all of them do, we'll give you some data in a little bit, get an IRA. It's similar to a 401k, but you don't need the employer involved. And then you set up automatic deposit from your bank account that when your money goes in, it goes into this IRA that you set up. So what's an employer match? Your employer contributes a certain amount of money based on your contribution. So examples, according to Investopedia, the most common match is 50 cents on the dollar up to the first 6% of the salary that I put in, meaning the employer adds 50 cents to every dollar I put in up to 6% of the compensation that I contribute. But what if you only put in 4%? You don't put in 6% and they're matching up to 6. Well, that's all they match, the 4%. Therefore, you're leaving money on the table. Now, on that, Financial Engines, an investment advisory firm, did a study. And they found 25% of employees who contribute to a 401k don't take the full match. They're leaving money on the table. Don't let this be you, being wise with the money you earn. This is crazy. You're getting 7.5% return in the stock market invested into your 401k. Now you turn down the opportunity to get a 50% return in the first year putting that money in because your employer matched. My last employer matched 100% of the first 6%. Many large employers do that. Don't leave a penny of this on the table. At a minimum, you need to contribute 100% of the match amount as you start your 401k. So first day on the job, find out what the match is, and that's what you've got to go with. And then adjust the rest of your lifestyle to make it work. If you have to eat ramen noodles, if you have to go ahead and have a roommate, if you have to make early sacrifices, waiting to buy a vehicle or whatever it's going to be, or getting an apartment with a view of the pool, okay, you may have to make some early sacrifices. To do that, you're going to be in great shape over the long term. So get the effects of compound interest working for you. So let's drive this home. If your employer matches, let's say, this example, 100% of the first 6% that you contribute, what is the minimum amount of contribution when you enroll? So what are you going to put on the plan? How much do you want to take out? They're putting 100% on the first 6%. So how much do you contribute? That's right, 6%. If not, you're leaving money on the table. That's an important step of starting. So some 401k stats. According to the Census Bureau, 41% of workers contribute to one. Not good. According to the Bureau of Labor Statistics, 56% of employers offer a match, and they net out to about 3.5%. Again, if your employer doesn't have one, set up an IRA. So what's the average rate of return on monies invested in the stock market? It's a pretty interesting question. Well, there's no promises, but you can look at historicals, and not that the future is going to mimic history, but if you look at a long period of time, you can get some comfort and some knowledge as you go ahead and dig through this. So there's a great chart that we're going to link you to in Links and Resources. It's the Ibbotson SBBI, stocks, bonds, treasury bills, and inflation. Ibidson is owned by Morningstar, and via the link, it will show you the rate of returns from 1926 to 2015. And there's charts like all over the internet, but it's the Ibidson chart, and you'll start to look familiar with it. So that's an 89, almost 90% period. So this is a chart that's starting pre the Great Depression and going through, recently to just a few years ago. It shows small company stocks on the Ibidson index return 12% on average per year over that long period of time. Large stocks produce around 10%. A lot of pundits say you can get 10 to 12%. I want you to be more conservative for your planning. I think that's too aggressive. So I turned to a very comprehensive article written by Pete the Planner. And we're going to give you a link in LinkedIn resources for that. It's a short read. It's not too technical, but the bottom line, he says he thinks the market going forward on average will be about 8%. So again, I want you to be conservative. It'd be great to get a good surprise down the road, but I just don't want you to get blindsided down the road. Let's be more conservative. I'm going to go ahead and I model my finances on 7.5% of what the market will do in the future. Remember, it is a play over time. In this case, 40 to 45 years of your career. Hey, but wait a minute. Isn't the market risky? Sure it is. But it has worked well over the long term. But let's look at the risks. Back to Ibidson chart. During this 89-year period, there's some major shocks to the market. Okay, the Great Depression lost 60% of the value of the stock market in 4 hours. That's a market adjustment. Pearl Harbor, 20% of the stock market vanished over 3 years. The Arab oil embargo, 48% of the value of the market went away in 2 years. The crash of 1987, 22% of the market over 2 weeks. The dot-com implosion, the Standard & Poor's index lost 50% of its value in 3 years. The NASDAQ lost 73% of its value over 3 years. The Great Recession, not too long ago, the Standard & Poor's lost 15% over 18 months. One point to make. Of these 6 market shocks that I've talked to you about, 4 were during my working years. So do you think there's going to be a market shot over your career? Yes, you're going to get a shock in your career. And you can't predict when it's going to be. You just need to be prepared for it and know what to do. Again, you turn to a licensed broker for advice. Most will tell you when the stock market drops, don't make any sudden moves. Think long term. Hold on, because historically, the markets always rebound. The great news is your next 401k payment, your investment into your account is going to buy stocks at a discounted rate. So it's going to buy more. And so figure the market is on sale. This is a great conversation to have when you do get a broker one day, or you're talking to your friends that are well schooled in this. Or you're reading articles about this. Have a plan when the potholes of life come your way in the future. So let's say you build wealth, 401k or other vehicles, and at retirement, how do you extract the money? Now, some stocks or bonds produce income via dividends. Others don't. So how do you extract some money without messing up your plan? Welcome to the 4% rule. It was created by a guy named Bill Bengen, a financial advisor in the mid-1990s, and it really caught on, and it's pervasive, and it's followed by many financial planners. In a simple explanation, in retirement, one can withdraw 4% or the retirement funds, your total retirement funds, in the first year. In subsequent years, he advises you to do 4% plus the amount of inflation. So you add that to the amount and you can withdraw that. This is a rule of thumb that many planners follow. Recently, Bengen revised it, saying 5% is more appropriate in today's market. Some planners go ahead and have a take on this and say, let's make it easy. Don't adjust for inflation. So go ahead and pull your money out at 4%. Keep the withdrawal amount constant. I suggest for your planning, be conservative and use 4.5%. So if you have $1 million in retirement savings, 4.5% would say you can take $45,000 out a year. If you have $2 million, $90,000 a year. I suggest reading about it, and we're going to offer you links to these articles in the links and resource section. Speaking of retirement income, what about Social Security? Will it be there for you? The good news is I think yes. When I talk to young people on college campuses, they think they're not going to get anything from there. Well, let me try to put your mind at ease. However, to be conservative, I would not factor Social Security into retirement for your early planning. Some people say, wait, hold on. Social Security is going to run out. It's going broke. Not so. Because here, think about it like this. When you get into the workforce, or now you're in the early workforce, you're funneling money up because you have to pay into Social Security. And then it is paying out to older workers who have retired. So what people are saying when they predict it will go broke, it's not going broke, you're contributing on your next paycheck. What these people are saying is the Social Security Trust Fund is running out of money. As of the moment that I speak here, it's taking the money that young workers are sending up to the retirees, plus it's not quite enough and it's pulling money out of the trust fund. Government experts say without any new adjustments from Congress, the trust fund will run dry between 2032 and 2034. But if that happened in the annual trustee report, it's estimated that as of today, again, Congress takes no action, retirees would receive 78% of their promised withdrawal when they go into retirement. So it's hardly broke. But again, don't plan on Social Security in your early plans and leave it for icing on the cake. Finally, when it's time to look for a broker or advisor, and I don't think you need to do that in your very early years, how do you approach it? My suggestion, the best ones will not work with you. They have a minimum threshold. It could be $500,000 or $1 million, and if you don't bring that to the table, they just go next. Okay? Unless a relative or a friend goes to the broker and says, I'd really like you to take this person in. They'll go ahead and do that as a courtesy. So it could be difficult to get the type of person you really want until you've established yourself. If all of a sudden you've got 5 or 8 years in the workplace and you've got a great plan and you're moving along and you're doing the kind of things we're talking about, certainly the best brokers will be more excited to bring you into their fold. So when you're looking for a broker, it's best to get a referral from someone you admire. And never take a cold call. You get a phone call and someone says, hey, listen, I'm not selling anything today, but I tell you what, we did this stock over here and it made all this money, and when occasionally I come along opportunities like that, you want me to give you a call and let you know. And you feel like a moron to say, hey, no, there's an opportunity like that and I'm not going to take the call. You're not going to take the call. You want to go ahead and never on a cold call. Why would they be calling you in the middle of the day and not talking to their clients? Because they don't have enough clients. I don't want that broker. And then when you do start to engage with a broker, seek their strategy. What do they want to do and how are they going to do it? And you want to ask them how they get paid. There's different ways of doing that. And you want to look for someone who is older and more conservative than you. They get that wisdom by living through a couple of these market shocks. You want them in the middle of the night to be shoveling, Rolaids in their mouth and, and just freaking out, waking up with sweaty palms and learning those lessons and bringing those to help you. So we've covered a lot today. I hope this gives you a good feel for investing. The most important thing is to start and be consistent over the span of your career. And that's what I'm covering in the next session. I'll see you then.